Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. We are essentially doing or focusing today's Talking Point on financials predominantly. We have the management of Union Bank joining in about 10-15 minutes. But before that, a very important voice who's been constructive on financials, Parag Thakkar of Santulan AIF joins in right now on the show. Parag, good having you. Thanks so much for taking the time out. How have you viewed the results of some of the financials that have come out? I want to start off with I don't know if you, look at it individually. And by the way, none of these are recommendations from you, Parag. But trying to understand, let's start off with Bajaj Finance because that's the main big boy of the day today. And then we'll move on to some of the others. What did you think of the numbers? What did you think of the commentary more importantly?
So, first of all, as you have rightly said, just a disclaimer from my side that these are my personal views. And one has to take buy call based on advice of financial advisors. I'm not recommending any stocks here. One overarching point in this results will be asset quality. I think that is where market was not so much focused in last 2 to 3 years when everybody was focused on growth and margins. Asset quality will be the main driver now. Because since we have started seeing some stress in some unsecured segments, as highlighted by RBI very rightly earlier. So I would say that Bajaj Finance, coming back to Bajaj Finance specifically, I think market was anticipating a higher, I would say NPAs, the higher credit cost guidance. And it came at a lower end of the credit cost guidance. And the growth rate has remained same in terms of guidance. And the stock was brutally sold and completely oversold, I would say. So for a quality franchise like Bajaj Finance, when you report a number which is better than what market anticipated, the stock is likely to react positively. And same, just to extend this thing, we saw results of Axis Bank, HDFC Bank also. Gradually, everybody will start seeing asset quality is a most important thing. It is again coming back into full action, and that is where nobody can beat HDFC Bank because the gross slippage ratio are at 1.2, 1.3% versus 1.8 to 2% for many other large banks also. So on growth, definitely ICICI Bank has more levers because their CD ratios are more comfortable. And on asset quality side, definitely HDFC Bank is undoubtedly the best. So I would say that, and I'm constructive on financials, as you rightly said, because see, their multiples are 35% cheaper than overall Nifty. So whatever earning disappointments or slow growth is priced in the stocks. And now that very rightly RBI has changed the stance from withdrawal of accommodation to neutral. So there is a surplus liquidity. So I would say the deposit problem is gradually easing, and which is very good for banks because that was a big issue up till now. So any bank which is lending prudently, which is a strong deposit franchise, ideally HDFC Bank or ICICI Bank kind of names, should do really well. And even in mid-cap and small-cap space, I would like to draw your attention that last time when we spoke, we did not speak too much about mid-caps and small-caps. But after yesterday's carnage, there are many mid-caps and small-caps which are also emerging as a value buys. Just to name a few better.
Parag, already, did you find the commentary of some of these mid-caps? Sorry, before you get into the names, did you find the commentary of some of these companies constructive, or is it that the valuations have become reasonable?
I feel valuations have become attractive because I'll tell you, from election standpoint, after election, the government spending is slow, right? Festive season is yet to see its, it is halfway through. So, and the vibes which we are getting from commentaries of various two-wheeler companies or car companies is not that great. So I would say that this is today you have to buy financials because they are undervalued, not because the commentaries are going to be great. Because definitely, as I said, and I'm expecting this from many banks which are going to report numbers like ICICI Bank and all, that more and more focus will turn towards asset quality. So I would say that on one hand, for example, just to give you, I was naming some housing finance companies like LIC Housing or PNB Housing and those kind of names. You see the P multiples. LIC Housing trades at 7P trailing. Now imagine a situation. They are lending to home loan buyers who are salaried. 80% of them are salaried. The tenure of the loan is 7 years, 8 years, right? So your market cap, which you are paying today, is going to come back to you in 7 years, even if they shut down the business today. Just that you have to just take a call that the housing loan borrowers don't default. And I don't think in India, macro wise or micro wise, it is such a bad situation that somebody will default on their house meaningfully, I would say. So PNB housing also, there's a 17, 18% growth. PE is just 10. So I would say that this is a valuation play. And remember, Niraj, in my view, you can make money in stocks from long-term perspective only when things are a little bit shaky on the ground, and so the valuations are reflecting that pessimism which is coming in short term.
Parag, the question that comes to mind is the valuations, let's say on HDFC Bank, right, have been very constructive for a while.
Yeah.
So people who've bought in HDFC Bank on valuations have not really made enough money or reasonable money relative to other sectors. So why now is the question.
Yeah, so that is why now is a very good question. See, when the merger happened, right? The merger happened with the logic that 4.5 lakh crore mortgage book will come, which will have a stable 8 year maturity. So it will give them good stability in terms of earnings and the loan book AUM growth. The point which happened after the merger, like liquidity got tightened significantly as US increased interest rates by 5%. In India, there was a rate hike of 2.5%. So suddenly the liquidity dried up. And when they needed it the most, right, CD ratio went up to 110%. Now they are quickly bringing it fast back to below 100. Right now they are at exactly just close to 100%. And the management endeavor is to bring down that as fast as possible so that they can again come back to growth phase. Right. So what I think, in my view, the latest quarter result, where they raised 1,20,000 crore deposits, brought CD ratio down, asset quality remained stable, and deposits grew with good asset quality. And combined with that valuations, I'll tell you, very simply put, FY27 EPS in my view is around 115. If you just give 15 times to it and add 250 to 300 rupees subsidiary value, it comes to 2,000 rupees. So from stock price perspective, also it offers good value from as it is a large cap. Plus, management has run excellent steps in last 6 months. See, they are these are and I love this genuine businesses which underperform, right? So because underlying value of the business keeps increasing while market is just focused on 2 3 parameters and they just don't take care of it, right? Because market wants excitement, market wants growth. Now here in the best thing in favor of HDFC Bank is that people know that growth is going to be slow because they want to bring the CD ratio down. So if they do execute very well as they did in last quarter on deposits, asset quality, and NIMs, I think we have a long way to go.
Okay. So you are buying financials despite asset quality not necessary, or despite commentary not being as solid because valuations are favorable. So that is one part of the bucket. You mentioned some thoughts around what you may find favorable, and viewers have to do their own due diligence. Beyond financials, Parag, I was looking at the results yesterday of a Kajaria Ceramics, of a Supreme Industries, of a Responsive Industries this morning. So building material related pockets, their first half has been very disappointing, but they are all guiding to a very strong second half. All of them are real estate ancillaries. The cycle still seems to be decent, even if it may be coming off slightly at the margin. How constructive or not constructive are you on some of the building material companies which are guiding to a strong second half?
I would say because I don't track building material space very closely. Of course, Supreme Industries is a fantastic company, super franchise, 30% ROC track record from last 25 years. And I have huge respect for that company. The only thing is that this space, I would say that this is one of the space which might hold on, because we have seen the last 2 3 years the real estate sales have picked up, and now people will be shifting and people will be doing interiors, and so building space is a material, is a space which can pick up, which can show some resilience and some momentum. Festive season is also going on, so I think uh, but the problem, Neeraj, with most of the sectors today, apart from financials as we speak, is valuations, right? So in many cases, which I would not like to name, in many cases the earnings are at bottom by valuation, while the stock price is at all-time high. So, and that is one of the reason I keep coming on to financials, where you feel, the stocks, just to say, as I told you, LIC housing trailing P is 7, Federal Bank P is 10, 11. And now with Mr. Manian kind of person coming in, and of course Sham has done it beautifully, I would say very conservatively, strong deposit franchise, and very conservative underwriting, I would say. But the only problem was ROI was not expanding, which I would say that in Mr. Manian's term, in the next 3 to 4 years, the ROIs will expand. So I'm saying that the problem with the market was, and of course it has corrected a bit now, which is good. But I would say that most of the market was running on narrative. And that is why when Nifty hit 26,000, we raised a huge amount of cash in the portfolio, which we are deploying now. Because we felt that everything was running ahead of its time. But now that after yesterday's carnage, I am seeing a lot of value emerging in the market. But still, see, I'll tell you, in a financial company, it's a leverage company, so you give lower multiple. That I agree, because it's a leverage business, and it's a just 1 or 2 or 3% ROI business. But the point is that there you are getting 15% growth for PE, which is less than 15, like in the case of say HDFC Bank or ICICI Bank. And these are very good names, right? So otherwise, in any other sector, if you go for a 15% growth, you are paying 35, 40, 50 times, which does not actually fit into my framework.
Got it. Okay. So you are, Parag, it seems that you are largely focusing on financials because there is a good quality at a reasonable valuation
Absolutely.
opportunity available. Okay. Is there any other pocket where you find the same construct?
So I would say that IT, as we discussed last time, TCS, Wipro kind of stocks.
No, but mid-sized
Uh,
IT, Parag?
so banking and IT are majority of the sectors. There can be some stocks here or there in other
Sorry,
sectors.
Parag, sorry. What I meant to ask was when I speak to persistent systems today, when you hear Coforge and their commentary and the growth, they are delivering growth already, even if they are expensive. Would you bet on that because they are delivering consistently, or would you want to bet on valuations, even if growth may or may not turn very favorable at the time horizon that you want in large cap IT?
So all credit goes to, I would say, persistent after Mr. Kalra has come and Coforge after the CEO has come. They have turned around the companies beautifully. Full marks to them. And the results were also fantastic. I saw a 5% constant currency growth in such environment. And now when the Fed is at a tipping point and Fed is ready to turn dovish, they already started doing a 50 basis rate cut to save, or I would say to protect US economic growth and job market. So I would say that IT is a fantastic space. They see, on one hand, financials is a leveraged space. On the other hand, IT generates huge amount of free cash flows and so dividend yield and all that. So I would say that I have stuck to TCS, Wipro kind of names. But 100% I will agree with you that Persistent and Coforge have lived up to their expectation. In fact, they've exceeded their expectations. The only problem with me is that I cannot buy a 35, 40 kind of P multiples.
Got it.
But there is no taking away from the fact that these companies have done beautifully.
Sure. Okay. Parag, I have one last question. Coming back to financials, but non-lending financials, and I want to specifically focus on capital marketplace. almost everybody who's been in the market and has seen for so many years now says that the next 5, 7, 10 years also, the growth could be explosive. Now, do you buy this theory, and therefore, do you buy or hold any capital market related plays, brokerages, AMCs, utilities in your portfolios?
So basically, see, this is the space which is where I belong to, right? So I
Exactly.
cannot be a pessimist in that space because I belong to wealth management business. But generally, my view is that I don't see, as such, we are invested in markets, as such, we are putting money in markets. Now, to play proxies or to play the same thing is not my DNA. So because we are already there, right? Why should we over leverage ourselves for stock market and for capital markets? That is my view. I see business is like AMC, for example, and I have worked with ICICI too. The businesses are excellent. Right? It is infinite ROC business. So business, there is no doubt on business, but at what value you buy and in what kind of cycle you buy. I think we have seen a huge amount of retail participation already in the market, and already regulators are a little bit worried about it. So I would not put my money into capital market related business now. I know this is a very, very contrarian view from others, and all the people whom I respect in the market and I have a huge respect for. They mostly are bullish on capital market related businesses, but because one fact is that they are high ROC businesses, high cash flow generating businesses like IT. But in my view, stock markets have their own cycles and they are very difficult to predict. And so, after such a big euphoria of demat accounts and after such a big euphoria of new investors coming in the market post COVID, I will not be very excited about this space.
Got it. Okay. Fair point. Parag Thakkar, such a pleasure talking to you. Thanks so much for joining in and giving us your perspective. And we continue our conversation on financials, by the way, on this talking point.